Between October 1719 and January 1721, 15 months, shares in the Compagnie des Indes went from 500 livres to 10,000 to 175, 20 times up, 98% down. This was the first systemic paper money bubble in modern European history, the architecture that every subsequent bubble would inherit. A Scottish economist named John Law convinced the French crown to print paper money against colonial monopoly equity. Then the equity collapsed. Then the paper followed. When it ended, France would not issue paper money again for 80 years. When Louis XIV died in September 1715, France was carrying about 2 billion livres in public debt, accumulated through 70 years of war. The annual revenue of the crown was approximately 165 million livres. Debt service consumed most of it. The regent, Philippe d'Orléans, faced a structural choice: default outright, default partially through currency manipulation, or invent a way out. Into that vacuum walked a Scotsman. John Law was an economic theorist, expatriate after killing a man in a duel in London in 1694. He had published a treatise in 1705, Money and Trade Considered, arguing that paper money backed by land or government revenue could expand productive economic activity. He had spent years pitching the idea across European courts. The French regent accepted. In May 1716, Law established the Banque Générale, a private bank with authority to issue paper notes redeemable in metal. In August 1717, he established the Compagnie d'Occident, granted a 25-year monopoly on trade with French Louisiana and the colonial Caribbean. Paper money bank plus colonial monopoly equity. The two pieces would merge into one integrated system. On December 4th, 1718, the Banque Générale was nationalized and renamed the Banque Royale. The crucial change: banknotes became legal tender for tax payments. The bank's note issuance was no longer strictly limited by metallic reserves. 6 months later, May 23, 1719, the Compagnie d'Occident absorbed the East India and China companies. The new combined entity was called the Compagnie des Indes. By the end of 1719, the company was both the largest corporation in France and the largest creditor of the French government. The share price arc accelerated. September 1719, subscription price 500 livres. October 1,000, December 3,000, January 1720, 9,000. February 1720, about 10,000 livres at peak, 20 times the issue price in 5 months. The mechanism was structural. The Banque Royale printed notes. The public used the notes to subscribe Compagnie des Indes shares. The share price rose. Demand for notes rose. The bank printed more notes. The loop fed itself. By early 1720, the Banque Royale had issued more than 2.5 billion livres in paper notes. The total metallic money base of France at the time was approximately 1.2 billion livres. Paper had exceeded metal. The integrated system had effectively doubled the French money supply through paper issuance. And most of that new paper went to subscribe Compagnie des Indes shares. In February 1720, with shares at peak, Law issued an edict making banknotes the only legal tender and limiting metallic currency holdings. The market read it as a confession that the paper was no longer convertible to metal. Confidence began to crack. In May, Law announced a planned 50% devaluation of banknotes against shares, an attempt to reduce the imbalance. The market read it as panic. The edict was reversed within days. The damage was already done. The slide was continuous. June, share price below 6,000 livres. August, Banque Royale notes themselves trading at a 50% discount to face value on the open market. October, share price about 1,500 livres. November, about 500. January 1721, 175. On December 28, 1720, John Law fled France disguised as a woman with the aid of the regent. He died in Venice 9 years later, a poor man. By January 1721, a 1,000-livre Banque Royale note traded for roughly 70 livres on the open market, 93% off face value. The share fell 98%. The paper fell 93%, both in under a year. The institutional response was complete. In December, the Banque Royale was dissolved. In 1721, the French government restructured its sovereign debt. In 1722, private banking was formally prohibited in France. By 1723, the law-era Compagnie des Indes was liquidated. A reduced trading company kept the name until 1769, but the integrated system was gone. Earl Hamilton's price and wage data shows real wages in Paris declined 25 to 40% over the collapse years. The total nominal value erasure of Compagnie des Indes shares and Banque Royale notes was on the order of 3 to 5 billion livres, against a French annual GDP estimated at roughly 1 billion livres, 3 to 5 times annual GDP in destroyed paper wealth. The deeper consequence was structural. France did not establish a functioning central bank or reintroduce paper money in any systemic sense until Napoleon founded the Banque de France on January 18, 1800, 80 years of monetary conservatism, directly attributable to the trauma of the Mississippi bubble. While England developed sophisticated banking and government debt markets through the 18th century, the Bank of England had been founded in 1694, France operated on a metallic currency basis with limited credit infrastructure. Historians link France's relative economic decline versus Britain in the 18th century to exactly this gap. Quick pause. This episode is sponsored by a private community I run. It's where the YouTube version of these case studies becomes a working toolkit for analyzing governance failures, monetary architecture mistakes, and the leadership decisions that turn experiments into catastrophes. If the architecture of 1720, paper money bank, monopoly equity, self-reinforcing loop, caught you, that's exactly what the inside is for. Link is in the description below. Now, back to the pattern. There is a pattern. 4 asset price bubbles, 4 centuries. In England, the same year, 1720, the South Sea Company collapsed. Same architecture, government debt assumption, monopoly trade rights, self-reinforcing share price loop. Peak August 1720, about £1,000. Trough December 1720, about £124, 80% down in 4 months. Isaac Newton lost around £20,000. 83 years before Mississippi, in 1637, Dutch tulip bulb prices peaked at multiple years' artisan wages and crashed by 90% within weeks. 209 years after Mississippi, in 1929, the Dow Jones Industrial Average peaked at 381 and bottomed at 41. 280 years after Mississippi, in 2000, the NASDAQ Composite peaked at 5,048 and bottomed at 1,140. The structural pattern is identical across all 4. Easy credit, asset concentration, valuation outrunning fundamentals, self-reinforcing buying loop, regulatory turn, crash, multi-decade unwinding. The 1720 Mississippi episode is the template all subsequent bubbles inherit. In 1719, French aristocrats subscribed shares at 500-livre. By February 1720, those shares traded at 10,000. By January 1721, they traded at 175. The architecture is unchanged across 4 centuries: easy credit, asset concentration, self-reinforcing loop, regulatory turn, crash. 1720 is in the archive. So is 1929. So is 2000. So is whatever happens next. Every market crash has a pattern. Here it is.